Hello everyone and welcome to the video. Today we are going to discuss the covered call option strategy. In this video we'll be discussing what covered call options are and how you can use them to generate income. If you're new to options trading, don't worry. We'll cover the basics and explain everything you need to know. So what are covered call options? A covered call option is a strategy in which an investor sells a call option on a security they own. This is called writing a call option. When you sell a call option, you receive a premium from the buyer of that option. In return, the buyer has the right to buy the underlying security from you at a specified price, the strike price, before a certain date, the expiration date. So by selling a covered call option, you are agreeing to sell the stock you own at a price you choose. In order to be able to sell a covered call option on a stock that you own, you must own 100 shares of the stock. This is because each options contract represents 100 shares of the underlying stock. So why would you want to sell covered call options? Selling covered call options can be a great way to generate passive income on the shares you already own. If you own a stock or ETF that is not likely to increase in price significantly in the short term, you can sell a call option on that security and collect the premium. If the security does not increase in price higher than the strike price you chose and the option expires worthless, you keep the premium. If the security does increase in price above your strike price and the option is exercised, you still make a profit because you sold the security at a higher price than you would have otherwise. Hedge funds also use this strategy as a way to hedge their large holdings against a drop in the markets. The premium earned from selling the covered calls makes up for a portion of the losses during a downturn in the markets. Let's go through an example. Say you own 100 shares of XYZ company, currently trading at $50 per share. You sell a call option with a strike price of $55 and an expiration date of 1 month from now for a premium of $1 per share. If the stock price stays below $55, you keep the $1 per share premium and still own your shares. If the stock price rises above $55, the buyer of the call option can exercise their option and you would have to sell your shares at the $55 strike price. But you still keep the $1 per share premium, so your effective selling price is $56 for a net gain of $600. Note that the premium of $1 per share you received from selling the call option is a 1.8% return on your money in 1 month. That's about a 22% annualized return if we continued this strategy each month for a year. Not bad, right? So as you can see, covered call options can be a great way to generate income while holding onto your shares of the underlying stock. Plus, it can also help protect your portfolio against potential losses. What are the risks of selling covered call options? While selling covered call options can be a profitable strategy, there are some risks to be aware of. One risk is that if the security increases in price significantly, you may miss out on potential gains because you agreed to sell the security at a designated strike price. Again, the goal of selling covered calls is to generate consistent passive income or hedge against a downturn in the market. That being said, when setting up the trade, you should be comfortable with your maximum potential gain and not get caught up in the fear of missing out on the upside. Another risk is if the stock decreases in price, you may experience a loss because the premium you received may not fully offset the loss in the value of the stock. However, this strategy should only be done on stocks that you want to hold anyway. So if the underlying stock does decrease in price, you should be comfortable continuing to hold the position. The advantages of selling covered calls can far outweigh the risks if it is done properly. In conclusion, selling covered call options can be a great way to generate income on the stocks you already own. I like to think of it as earning rent on an initial principal investment. However, it's important to be aware of the risks involved and to carefully consider whether this strategy is right for you. If you'd like to learn more on options trading and how to safely generate passive income, check out more videos on my channel where I go into more specific examples. Thank you for watching and happy trading.